All right, Mr. Peck, where would you like to sit or stand?
Well, it doesn't matter. Is this the video right here? I need to probably look at that. So you're gonna have, that's gonna be shared though, right?
Yep, it's already up there.
It's already up there. Where's the easiest? It's not as
Wherever you're comfortable.
Put it over here.
Evan, can you hear us okay?
You're a little quiet.
Yeah, probably will. I'll probably spin the camera, stand right here.
All right.
That way I can look up at the screen.
Get your close up.
I know, right? Boo.
Can you hear that okay?
Maybe just a little louder.
It doesn't look like I'm filling up my nostrils as much. So what's it's in
Oh,
slideshow mode already. What
Yep.
I gotta do to change it? Just the arrows.
Yep, just the arrows.
So when is it? When are you projecting live, or is it live right now?
Is that right now?
It's already live right now. She wanted to do. Sandy, did you want to do an announcement or anything? Sandy's at the front. There we go. For all of us.
Cool, and then I'm just gonna sit on my computer and just accept people joining.
Okay. Can you go in the chat box and let everybody know it's gonna start at 10:10?
Yeah.
So that they know. You give it 10 minutes for more people to show up. Yeah, this long. And then range. Close that. No. Check. be with corporate entity. They just don't even know where it's at. It's in cash. That's what the allocate. Like, you know, like one that has to be. So like when you do a brokered loan, you check and it goes down to corporate, it goes through treasury, you know, it goes through all these steps. I have emails saying about it. It's like gone. And so they won't pay the loan because they don't have record of the check or anything, even though they said they did have it. And I'm like, you guys, they're always getting pissed because they're getting closed in September. So they're supposed to get paid in October. And they're supposed to be paid in November. Paid in December. And it's not a big check, it's just more that it's just so inefficient. It's crazy. Really crazy. Do you want to talk first?
No. Yes.
It's just super weird. She said she's got it later. So it's even still. Hey, there he is.
Hey, how's it going?
How are you?
Yeah, good to see you.
Good to see you too. I actually ran into him down in Mexico at the resort.
Yeah.
Him and his son were down there. What's that?
Yeah, did you have a good
Oh
time?
yeah, I had a great time. Nothing to complain about. Obviously got back and
Yeah.
cold and wet. And
Yeah.
gross, right?
Yeah. Great running water.
Yeah, I know. Did you get some runs in?
Yeah. Beautiful down there running on the beach.
He runs like 50 miles a day.
Oh,
That's crazy stuff.
I used to run biking more, preserving the body.
Exactly. Lower impact. It is crazy stuff. He does he's telling me about it when we were down there. Drinking a beer, I ran into one of his kids. I'm like, oh, I ran into his son. I'm like, I swear to God, that's his son. Like, you know, you see somebody like, he's got it, but I'm like, that's not right.
Tomorrow's food, huh? Tomorrow the platform.
Oh, yeah. I started on my list. I started
Oh, I
on
gotta find mine.
my Did you have
I
it?
have it. It's just it's in a box in the shop.
Ready? Want me to do it? We're gonna let-
I'm here.
You're
We can start
you're
then.
here. Yeah, we can start now. She's here.
I'm here.
So are you recording right now? or
I
you
am
wanna
recording
wait?
right now.
Okay.
Yeah. All right, yeah, you're all yours.
It's all us.
All you.
Good morning, everybody. How you guys doing? Hope everybody's doing well. I can see about 6 or 7 of you guys on the screen. I'm not sure how many total is here, but we just thought we'd come to the office and do a little bit of a mortgage update. There's quite a few things that have been changing in the world, all for the good, which is good news given what we've all dealt with the last couple of years. So real quick, just a little agenda here. Of course, now it's not working. There it goes. Just a couple of things we're going to talk about. One of the things that for the longest time that we've had people ask about is blended credit. That's where if you have somebody with really bad credit, somebody with really good credit, is there a way to still get them a loan? That's a new thing that's changed. Obviously, conforming loan limits have gone up. So chat about that a little bit, and then a couple new products we have. So give me a few minutes of your time, and we'll get through this here pretty quick. So one of the things that changed just in the past few months is they are allowing what's called blended credit now. It used to be that if you had somebody that had a sub 620 credit score, they couldn't even be on the loan. There's been numerous times in my career where I've had a 580 credit score and then a 750 credit score with another borrower, but yet we couldn't put that one borrower with that lower credit score on there. And then of course you lose their income, which then affects their ability to qualify. Now we can go in and we can blend the two credit scores together. I kind of see an example there. Pretty easy one. But essentially they take the low score and the high score of the two borrowers, blend them together. And as long as the median is over 620, they can both be on the loan. And then that enables us to use the income and everything there. That's been a pretty big adjustment for us, not something that we've been able to do for a very, very long time. But it's something where, it should give you guys
You're muted.
apparently the internet went down for a moment.
Yeesh.
So all backwards up. I have no idea where we got lost. Do you know where we got lost?
It's literally just.
It literally just cut. Okay, so kind of talking about conforming loan limits here. The conforming loan limit went up about $100,000. Last year it was $548,250. That just essentially means that you can get a Fannie Mae or Freddie Mac loan anywhere in the country, up to a loan amount of $548,250. That was the 2021 limit. For 2022, that's getting increased to $647,200. That is a now number. So we are closing loans at that figure right now. The second they make the announcement, we can immediately lock loans at that new number. You may have seen some lenders were already preemptively increasing the number. Even Caliber increased it to 625 a month or so ago. So that number now is out the door. That was just them, us going in saying, hey, we know the number is going to go up significantly. Let's just go ahead and start issuing loans at the higher number. That number now is 647,200. So you should see that. The 2, 3, and 4 unit numbers, of course, those are duplex, triplex, fourplex figures. Now that's the nationwide number, not to be confused with the high cost tri-county area of King, Pierce, and Snohomish County. We get expanded limits. That's where the conforming loan limit is different for us in that area. That figure, as you can see, went up to $891,250. Last year, that was $776,250. So more than $125,000 increase there, or $115,000 increase on that. It essentially means somebody in that tri-county area can get a Fannie Mae loan at 5% down, and essentially buy a $938,000 house. So, and they can get regular conforming loan money. Why that's a pretty big deal is because there's not really a jumbo product out there. Once you go over that number, it's a jumbo loan. That jumbo product, while it's getting more and more expansive and there's more and more product coming together, jumbo loans have really restricted debt ratios. They have a lot stricter credit requirements, reserve requirements, all these things that make it harder to get a loan. That's where the jumbo loan is, whereas a conforming loan, the debt ratios are looser. There's less reserve requirements. The way that they treat student loans, the way that they treat car loans or RSU income, all these different things that go into how you qualify somebody, it's usually just easier on a conforming loan. And so this just really opens up the envelope for more and more people to encapsulate that money and make it easier for them to qualify. Now, the one thing to kind of note that I just want to make sure of is that, remember, these are loan amounts. They're not sales prices. So that's kind of why I highlighted the 938 as a sales price on 5% down. So again, pretty much they can buy $1 million home and put 10% down, or a little bit over 10%. So those are the maximum loan limits. We can also do first and second combination mortgages. So again, we can go to 80% typically on the first mortgage, and then go to 90% on a purchase money second mortgage. So again, you can start pushing that sales price on 10% down up into the 1.1 to $1.2 million range, and they can still get really good low down financing. So those are just things to look for to as prices go up, which is something that we've been dealing with on a pretty aggressive level the last couple of years. It enables more and more people to have access to cheaper money with lower down payments. Slide number, again, it's not, there we go. So one of the things that we wanted to kind of highlight, which has been out for a while, is the Caliber Go product. What this is, and this is just something where in the ever environment we're in, where, you know, and we were in, where it seemed like we had to do really short closings, you know, everything that we could do to give our borrowers an inch so that they could try to win a deal when there's 15 offers on a property. The Caliber Go product was created to essentially mitigate the underwriting process and really make it streamlined. As you can see, there's some requirements below there. You know, it's not for self-employed borrowers, got to have minimum credit score requirements. Essentially what they did is they created a loan product where it bypasses and puts it on the fast track so it can close really, really fast. It's meant for people that have W-2 jobs, not a lot of variances, really simple borrowers. You'd be surprised that about 80%, 70% of the borrowers can fit into this bucket that are doing a loan. And so if they're trying to do a really, really fast closing, what it does is it enables us to, we code the loan a certain way as long as it meets requirements, and it will take a different path through the underwriting process after the file's mutually accepted on an offer. The Go products also have a higher rate of getting what's called a PIW, or a property inspection waiver. That means that more than likely, again, it's not a guarantee, but a lot of these properties, when they are run through, there is no appraisal requirement needed. And so they can close really, really quick. It's just a way where when the borrower is getting qualified, you know, talking with the loan officer about can they do this product to make it go faster, is something that you can bring up. Again, it's only for certain scenario borrowers. Like I said, mainly salaried income, people that have retirement income. It's people that are on a fixed income where there's not a lot of variables to their jobs. They have to put a minimum of 5% down. You start throwing in people that have, you know, rental properties or, you know, side business or anything like that. They can't use this product because it just doesn't go and work with the documentation. But it's something that as we go into the spring market, you guys should know is there, just because you can actually close transactions in 10 to 14 days. It is running the 100-yard dash pretty quick, but there's a lot of scenarios that, that this product works for, and can make it so that your offer looks better. So the next 3 slides that, and really the reason I reached out to Shai was to kind of go through these products with you guys. If you guys remember a year and a half, 2 years ago, Caliber Home Loans had some portfolio products. Interest rates weren't great, but they fit a niche of borrowers where maybe they had a short sale or a bankruptcy in the last couple of years. You know, all of your, you know, jumbo product, your conforming loans, which are your Fannie Mae, Freddie Mac, your FHA, your VA loans, those are really all bond driven, you know, pretty much A paper products. I mean, they're mortgage-backed securities. Millions of these loans are issued. They fit the masses. And Caliber created portfolio products to not fit the masses, to go in and create products that, you know, could be niche products for the people that didn't qualify for all those other products. And when COVID hit, they took all those away because they are true portfolio products. So when the market wigged out, a lot of lenders pulled back all their portfolio products. Well, those have now come back. They've rebranded them into having different names. They call them the Smart Series. The first slide you're looking at is the Smart Self. What that essentially is that is a bank statement loan. I think in the past 18 months, I've been asked, you know, 4 to 5 times a month if these products are available. These are for self-employed borrowers that make a lot of revenue, a lot of cash flow, but when you get their tax returns, they show that they don't make any money. And they have a really, really hard time qualifying for mortgages. Believe it or not, the bulk of your self-employed borrowers that have pretty large businesses, You know, a lot of them want to buy really expensive homes if they make good money, but their tax returns don't show it. This product is designed for that. It literally runs off of their bank statements. It runs off of deposits, and then they run an expense ratio off of it. You know, there's both the 12-month and the 24-month version of the bank statements. The difference between the two is the 12-month has a higher interest rate because they're basing the income off of a lower amount of bank statements. It can be done on a purchase, rate term, cash out, refi. They run a 50% debt ratio on it. These are true portfolio products. So these are not Fannie Mae or Freddie Mac backed. These aren't government loans. These are products that are stuck in our portfolio. The major difference is that right now, with the products that we have today versus the ones Caliber had a year and a half ago, is these products are built on a platform that makes their interest rates only about 1 to, depending on the scenario and credit score, 1 to 2% above what a Fannie Mae or Freddie Mac rate would be, whereas the older Caliber products were 3 to 4% above. And so these are a lot more competitive and have a lot better interest rate than you would see in the past. We have put these products out to test, and we've had numerous clients that have to get portfolio loans like this tell us that these rates are much better than what they're finding by other lenders, which is a good sign. So this is, again, a self-employment feature. You can do a 30-year fixed, you can do an ARM. You can see at the bottom there, they do, again, these are true portfolios, so that lovely interest-only feature comes back into play. They can opt to get the interest-only feature to make their payment a lot less. MRB income, just to touch on that, that's on the slide. That's mortgage revenue bonds. That's just an income that's allowed. Essentially, if somebody has a, any type of a, a government bond, whether it's a state or a city bond or something like that, that it creates a yield on it. Those are income that we can use to qualify. It's actually not going to be something you're probably going to see a ton of. And obviously loan amounts up to $3 million. Down payments on a purchase transaction as little as 10%. The next loan is the Smart Vest series. So this is a pretty unique one, and this is one that we've been starting to use. It is a blended, I call it a blended or hybrid. It's a residential loan that has commercial underwriting features. What they've done here is they've taken, so as you're aware or may or not be aware, but Fannie Mae and Freddie Mac only allow investors to have up to 10 finance properties. So there is a lot of people out there that have a lot of rental properties that once they get to 10 units, they've got to seek financing elsewhere. They got to go old school lending to a bank or a credit union and get a regular portfolio loan because they cannot get an insured loan through the government. And this loan is meant to do that. It goes up to 30 finance properties. That's one feature. The other feature that it has is this loan will allow you to close in an LLC. That is typically not a feature of a residential property loan. That is typically a commercial style loan where they'll let you close in an LLC. They allow this product to close in an LLC. They also underwrite the product on a debt service coverage ratio. We have gotten a couple of these loan approvals back. There is literally no documentation in them. They want very little. They don't want any income. They do need assets, obviously, for reserves. There's no tax returns. There's no pay stubs. There's no W-2s. They run off of a debt service coverage ratio. What that means is they are going to pull the operating income statement on the 1 to 4 unit property from the appraisal. If they, just to keep numbers simple, if it says it's going to rent for $3,000, the mortgage payment has to be under $3,000. It's a 1.0 debt service coverage ratio. You can see that there on the bullet point for purchase and rate term refis. The product works really well for multifamily just because in our area here locally, the multifamily property is typically churning a higher cash flow monthly, so it makes it easier to borrow more money. Single family residences, again, it's still a 1% debt service coverage ratio, but given our price point of our homes around here, sometimes we've been seeing that that makes the down payment a lot larger because they have to put a lot of money down to get the debt service coverage ratio down to 1%. Again, these interest rates, when we've priced them out, have been between 5 and 5.5% on a non-owner occupied. It is only for investment properties. You can see there the credit score now goes down to 640, 20% down on purchases. Again, just like any loan, the more money they put down, the better the interest rate and terms. But again, these products are meant to fill a niche. They're not meant to take over what Fannie and Freddie does. They're meant to fill in what they don't do. And Fannie and Freddie will not finance. They will not finance in an LLC. They will. You can move the property into an LLC, which a lot of investors do. But a lot of investors want to actually, a lot of your anybody that's had property flips out there, you've got a lot of your investors. They want to write the contract in the LLC. They want to close it through the LLC. They want to refinance it that way. And typically, to get that done, they have to go get a commercial style loan. These are commercial underwriting guidelines for residential properties. Now up here, I just want to make a note. I did say up to 30 finance properties, up to 20 finance properties is what the bullet point says. They will flex that and go higher. It depends on down payment, depends on the amount of finance properties Caliber has. There's all these different rules, but essentially it really is going to open up your investors to go out and get better money for investment properties. I've had a lot of requests for this for, what you might want to say are not necessarily property flips, but people that want to buy homes and maybe hold them for a year, rehab them, fix them up, and then sell them. This is not a hard money loan. We can do these loans with little to no loan fee, and the rates are sub 6%. And so that's going to beat out any hard money loan. It's not meant to be used for a property flip, but a lot of investors are using these for 1 to 3 year holds, which they're way cheaper in terms of the cost of financing. The next one is the Smart Edge. That is your owner occupied, doesn't fit again in the Fannie, Freddie, or jumbo guidelines. So this is somebody that has an issue to a foreclosure, a bankruptcy, a short sale, whatever's going on, or their credit score doesn't match, or again, 50% rate. You would be surprised how many people want to buy a $2 million house. A jumbo loan requirement is 43% by and large. There might be some products out there like this one that'll go higher than that, but there's a lot of people out there that, again, given the price of our homes locally, they want to buy houses and their debt ratio is just high. It could be because of consumer debt or whatever. The jumbo product does not allow that. They also don't allow a lot of income calculations to be used for RSU income. We have a lot of that around here with Amazon, Microsoft, Zillow, all these major tech companies, how they pay their employees. They don't like to be really flexible, and this product gives that flexibility. The rates are not horrible. We've seen them on owner occupied, about 0.5 to 1% higher. Now, again, these are people where they can't get a loan somewhere else. These are the ones where they call us to get a loan. They may call us first, they may call us second. They don't fit into the jumbo bucket or the conforming bucket at all. They're being told no by everybody. This gives them an option to get a loan. So this loan is meant to be for a borrower that can't get a loan anywhere else. They're not going to go to Wells Fargo, PECU, regular product. No one's going to do a loan for them because all those products are underwritten relatively similarly industry-wide. These are for the people that can't get a loan somewhere else. And so it really is their only option. And again, like I was saying earlier, a year and a half ago, this kind of a product was a 7 to 8% interest rate. These products are much better in rate. And so getting them qualified and giving them a relatively better or closer to market rate is a lot easier to do. And so that makes it really, really good. Other than that, I don't have a screen for Q&A. I'm not sure if Sadie's going to have that there. What I did want to do here is I do have my colleague Matt with me. Matt is really good at paying attention to the market and analyzing it. And so I'm going to have him chat for a few minutes here about what interest rates are doing, a little bit of a forecast there, and then I'll see if Sadie wants to get the chat board up for any questions.
All right. Hey, everybody. So we've been, you're still hearing on the news and on the radio and stuff that interest rates are still at historically low levels, which they are, but they have increased a little bit. So I just want to touch base real quick on a couple of the reasons why rates have increased. So right now we're seeing rates right in the 3 to 3.25 range. Prior, back in September, we were still sub 3. The reason we've seen rates come up a little bit is you've heard in the news about the Fed tapering. And what that means is that the Fed is just buying less mortgage-backed securities, okay? So the less mortgage-backed securities that are being bought is just, it's taking a big buyer out of the market. Not that they're out of the market at this point, they're just slowing their purchase of those mortgage-backed securities. So that takes rates up a little bit. And the other thing is the biggest enemy to mortgage rates is inflation. So we've all heard inflation on the news. Everywhere we turn, we're hearing, the term transitory inflation as well. Transitory inflation is just thought to be temporary, right? As soon as we get the supply chain issues resolved, as things get caught back up, they're thinking that inflation will come back down. But what's interesting is the inflation numbers that we're seeing right now, if we were in kind of a different environment, we weren't in this COVID environment, we would be seeing rates probably right now, I'm totally speculating on this, but I've been in the industry for 20 plus years. So with the levels of inflation numbers that they're talking about, we should be seeing rates in the 5-6% range. I mean, when I first got in the business in the mid 90s, we were doing rates, we were doing loans in the 7-8% range. So, the Fed's doing a good job of, keeping rates low. That obviously helps you and I, right? And the Fed knows that the housing market is a huge driver, if not the biggest driver of our economy. So the Fed is going to continue to do everything that they can to keep those rates low. So even with these inflation numbers being really high, don't expect rates, there's some people saying that we may never see, in the rest of our careers, which might be another 5, 10, 15 years, we may not see rates above 5% again. There's a lot of people saying that out there right now. But one of the main analysts that I listen to and pay attention to, he's still very bullish on rates, meaning that he's bullish on mortgage-backed securities, which means that he's very bullish on rates coming back down and staying low through 2022. So a lot of moving parts to that whole thing. But again, the key things to pay attention to is those inflation numbers and also the tapering. So the Fed will continue to taper. That's going to, be kind of a headwind for mortgage rates. The inflation, it's actually, there's some inflation numbers out there that show that it's starting to level off, which is a really, really good indicator that, we kind of might have peaked, in this little short term, peaked in rates. It'd be nice to see those come back down kind of sub 3. That's just kind of a benchmark. It's kind of I don't know, I want to say necessarily a trophy, but people like to see those rates under 3% versus over 3%. So that is all I have, other than the first Friday of each month is the Fed announces the new job creation. So last Friday was a big miss. They expected 210,000 new jobs created. No, I'm sorry, they expected 550,000 and only 210,000 new jobs were created. The inflation numbers were lowered as well. That inflation number, though, don't pay a lot of, not the inflation, I'm sorry, the unemployment number. Don't pay a lot of attention to that unemployment number, only because that unemployment number is factored by the amount of people that are looking for a job. And I think that we all know that there's some people that are definitely not looking for a job. So even though that unemployment number is really low, which
Yeah,
Sorry,
yes, we
everyone.
do.
Today
Yes.
is a bad day for internet. Okie dokie.
Sorry about that, guys. I think we were done anyways. It didn't start timing out on you
Yeah.
until, yeah, so Matt gave the market update. If you guys have any questions or need anything, Sadie is gonna send out, she has the PowerPoint presentation, so you guys can have that, as well as, it'll also have obviously all my information on there. If you need anything, give us a buzz. Would love to help you guys out. Everybody have a good rest of the week, and if I don't see you guys, have a great holiday. And 2022 is gonna be awesome. See ya.
How much has changed?
I know, right? What did you?
Blended credit scores?
They do, I know, that's
How is
crazy.
that like numbering? How is that?
You know, well, what's funny is we're so used to not having it, a lot of loan officers are forgetting it's there.
Right.
So like, we're not used to, our brains, like my brain is not trained to go, you've got to kind of like reacclimate yourself to doing it because it's pretty foreign. I mean, you can go in and, I mean, yeah, if you have a 5